Good morning, Lease Accounting. I know we're very excited about Lease Accounting. I know that it seems like I've spoken on this topic the last three catalysts. This is the fourth year. I know you're wondering what could he possibly tell us today that we don't know or we haven't already heard. Well, we have at LBMC we have helped several publicly traded companies and privately held companies already transition to these new lease accounting rules. And through that process, we've learned a lot. There's been a lot of additional guidance that's come out over the years. There's been a lot of lessons learned from our own assistance helping our clients. There are some very helpful updates today that I want to provide, just some changes to the some ASUs as well as an exposure draft. And then I want to just talk about some implementation lessons learned. Just a little bit about me. Lauren, go back one slide, sorry. Just a little bit about me, shareholder at LBMC, a little over 12 years experience. Worked in healthcare my entire career. I do a lot of accounting consulting around lease accounting as well as complex transactions, business combinations, complex leasing transactions. Prior to LBMC, I have 4 years of software development experience, healthcare or a hospital IT company. Go ahead and advance the next slide. And for my regarding the agenda today, I just want to talk about initially just going to give an overview of the changes with this new standard. I know some of this will be repetitive, but I just wanted to hit the high points. I want to give an update of what's occurred since last year with the codification and an exposure draft, and then I'll dig into the implementation lessons learned. Just a quick overview of the changes. As we, are aware, presentation of our operating leases is going on the balance sheet. This is the biggest undertaking, the biggest change. We will have no change to our income statement or to our cash flow statement. So I know that's a question that I often hear, and as the private companies are preparing for transition January 1 of 22, that's a question I often hear is, I haven't, estimated the impacts to my EBITDA, or I haven't estimated, what this will do to any of my earnings metrics. Well, the good news is it's not going to impact this at all. You're going to continue to have straight line rent expense even after you've grossed up your balance sheet for these operating leases. We're going to have expanded disclosures. So you're going to be required to disclose the weighted average remaining lease term. You're going to be required to disclose the weighted average discount rate that you use to calculate those present value of those operating lease liabilities. There's a requirement to disclose a more or less a full rent reconciliation, where you denote the amount of expense that relates to capitalized operating leases and as well as other rent expense categories that that don't relate to those capitalized leases. And then there's more disclosure requirements just around the nature of leasing, the types, the classes of assets that you lease, whether it's medical equipment or manufacturing equipment, or power utility locations, whatever it might be. Again, we do have some changes to our classification testing. So under 840, we had these bright line tests, 75% of the useful life test, the 90% test. Does the agreement contain a bargain purchase option? Consistent with 606, we're moving away from that rules-based, bright line-based accounting rules, and it's more principles-based. And so you'll see it more comes down to under 842, we're looking at what is the economic substance of this transaction. Are we consuming the economic life of this asset, whether through paying for it financially or through actual use over time, or do we intend to purchase the asset at the end of the lease agreement? And again, all that's based on, you know, the facts and circumstances at the day that you enter into that lease. And then we do have a new classification step for and this is more relates to equipment. You know, is the asset so specialized that it has no alternative use? And that would be if you had something custom built and somehow you negotiated a lease arrangement for it. It might occur in a sale leaseback type transaction. And then, you know, no surprise here, but our effective dates for our private companies have moved back to 1/1/2022. And then for our public companies, they've already transitioned, and that was January 1, 2019. And just an update on the updates that have occurred since last year. So the first was ASU 2020-05, which was as a result of the COVID pandemic, and that was a deferral, codifying the deferral of the lease accounting standard for private companies to January 1, 2022. The next was ASU 2021-05, and this relates to lessors, lessor accounting, and it relates to variable lease payments. This pertains to lessors with leases that have variable payments that do not depend on an index or a rate. So if you have, you know, a lease that, if you're leasing something and all the payments that you're expecting to receive from the lessee are based on a percentage of sales or a percentage of some other metric that isn't an index or a rate, that would generally result in a selling loss day one of leasing that asset to that lessee. And that, you know, this generally occurs when you have a longer term real estate lease arrangement. And it can occur in retail with common control entities. Sometimes it can occur with public utilities, or, you know, like a utility plant, or you know, nuclear power plant, something like that. And the update to the guidance for this issue that was identified by users was that if it's determined that there's a day one loss in these arrangements, which really doesn't represent the economics of the transaction, nobody would lease something under the expectation that it would result in a loss. Those leases will no longer be classified as direct financing or sales type leases, where you would de-recognize the equipment or the property on day one. They will now be classified as operating leases. And so the lessor in these arrangements will continue to keep the real estate or the equipment on their books, and the variable lease payments will be reported to income as received on a periodic basis. So it's a nice some nice relief for those lessors that have a lot of these, you know, variable payment arrangements that are based on something like sales. Current project or exposure draft that's underway is discount rates for lessees. There's some relief that's coming for private companies. This is the result of the Private Company Council consensus. Currently under 842 private companies, they have the option to utilize a risk-free rate, which would be like a treasury, a T-bill, or something like that. But they have to utilize that relief wholesale. So you have to apply it to all of your leases. So if you have some massive real estate leases and then you have some trivial equipment leases, you have to use that risk-free rate for all of those. Now, the trouble with that is that the risk-free rates are generally very low, and incremental borrowing rates generally are higher. And so the discounting effect of those using a risk-free rate is very minimal, which results in much larger lease liabilities, which could trip covenants or it could just cause an optical issue with your balance sheet. But now, as a result of this exposure draft, user or companies will be allowed to apply the risk-free rate expedient or option on an asset class basis. So most commonly what I would expect is that companies that have a lot of short-term equipment leases, like copiers and mailing machines, they will utilize a risk-free rate for those leases. And then for their real estate leases, which generally might be longer in nature and have much larger lease payments, they will utilize an incremental borrowing. Now, if this expedient or this relief is applied, you will be required to disclose that fact. But it's expected there will be no change to the weighted average discount rate calculation. The next thing I want to talk about is I want to dig into some of the implementation lessons learned. This is something that I've seen and I've helped implement with a few companies already, and I wouldn't generally discuss this as an accounting approach, but the FASB recently released an example on their website of applying this approach as an easy way to be compliant with 842. And they refer to it as the display approach. I would think of it more as a snapshot approach. That's what I would call it. But it's a way that you can kind of navigate around all of the monthly debits and credits associated with with each lease. Because if you think about it, every lease that you have every month, you probably have 3 to 4 to 5 journal entries that you have to record. And under this approach, you just look at your lease portfolio at each reporting period, and you record the ending balances. So I'm going to go ahead and, if we can, go to the next slide, Lauren, and we'll, in just a second, let's go back to the previous slide. But I just want to show go to the next slide, please. Yeah, so here this is just an example of a capitalization table or an amortization table. You would have one of these for all of your for every one of your leases, and the idea is that you would have a summary sheet that pulled the ending balances at each reporting period onto, go to the previous slide, Lauren, onto this slide, and you see that we're just pulling the ending balances. So this would be as of 12/31/2022 for each one of your leases. Note that all the leases have different discount rates, different terms, but we're just pulling the ending balance. And at the top, we're totaling what those ending balances are for the right of use asset, which is in that column H, and then the right of use liability, which is in column L. At the top, we're summarizing those in the journal entry format. So this would just be one journal entry that's reported at the end of each reporting period. Where maybe you do this quarterly, maybe you just do it once a year. I would expect that some of my clients that have smaller leasing portfolios probably just are going to want to do this once a year. So now you might notice that the right of use asset and the right of use liability are not the same amount, and that's because these leases have escalating lease payments, and so the difference there is as a result of additional lease payments or cash payments that don't equal the rent expense that's been captured. Because under this approach, we don't make any changes with 840 with our current accounting. We just record invoices as they're recorded, as they're received. And so as a result, you can see that we haven't recorded enough rent expense. And we could prove this out by looking at the the actual amortization tables and comparing those to the invoices that we receive. But high level, this is the reason that we record the difference to rent expenses, because it's necessary to true up your straight line rent. It's a straight line rent adjustment is effectively what it is. Under this approach, you want to be mindful of prepaid rent or accrued rent payments. You don't want to double up. So I would expect that, the first time that you go through this exercise, you're probably going to analyze your prepaid balances as well as your accrued rent balances to verify that you haven't, doubled up on anything, or you don't have any adjustments that are needed. Perhaps you need to, you've grossed up a prepaid rent payment. So you've credited accrueds and you've debited prepaid expense. That's common. I see that all the time as an auditor. And so you just want to ensure that you've removed that just with a simple reclass entry. But perhaps you've already expended the cash, and you might need to adjust it to the P&L. Maybe you've got some kind of adjustment like that. So you just want to be mindful of what's already on the balance sheet for those operating leases when you take this approach. And that this is something that you can adopt. You can adopt this after you transition. You can take this approach at transition. So you have a couple options there. Again, this is intended to, and I think the reason the FASB released this was there was a lot of concern around all of the journal entries associated with, with this new standard. And so I think it's a nice, elegant approach to accounting for accounting for this. Laura, please go to the next slide. And again, this is just a visualization of what one of these capitalization tables looks like. This is something that you could get directly out of a software system. So if you're utilizing software for your lease accounting, they should be able to spit out a capitalization or an amortization table, which just shows you the burn down and the related rent expense every month. Or you can build these in Excel. Again, if you have, I've said this before, but if you have 25 or more real estate leases, you probably want to look at software. There's a lot of things that you can get out of software that will make your life a lot easier around business intelligence, renewals, square footage calculations. There's a lot of things that those software solutions that can provide that you really that can get a little unwieldy trying to use Microsoft tools. And here I just want to talk about some additional lessons learned. Deferred rent. I've spent a lot of time helping companies transition, and deferred rent is always an issue. It's something that always comes up, and because it's, what do we do with this balance? Well, on what should occur on a lease by lease basis is you should take that deferred rent balance and reclassify it to the right of use asset, and you amortize it over the remaining life of that lease. The trouble with that is that these software systems that that do all these calculations for you for 842, they typically calculate a cumulative difference at transition that does not equal what you've been maintaining in your Excel schedule for deferred rent. And I'm not surprised, because those schedules sometimes, there can be issues with them, or maybe there's just maybe a payment amount just got miskeyed. So to help relieve some of the issues around trying to manage the lease by lease deferred rent balance issue, I would recommend reclassing that balance in total as a single contract asset to the right of use asset and amortizing it over the weighted average remaining life of the assets that it represents. And so you might, typically equipment doesn't have, I've seen it before, but typically it doesn't have escalating lease payments. And so therefore you wouldn't have any deferred rent for equipment. So if you analyze your real estate portfolio and you see that the remaining useful life, or the weighted average remaining useful life of those your real estate leases at transition is 4.5 years, then I would reclass that deferred rent balance to the right of use asset as a contract asset, and I would amortize it over 4.5 years. I think I would be hard pressed to be convinced that doing it on a lease by lease basis would give you a much different result. The next is utilizing the portfolio approach for discount rates, asset classes, lease terms. You don't have to try to nail it with every single lease. Try to figure out the discount rate specific to every lease. I would, and what I encourage my clients and those that I've already assisted, with this standard is come up with establish your discount rates, once every 6 months or once a year or once a quarter, and utilize those rates, throughout that quarter. Don't try to, every time you enter into a lease agreement, just try to figure out, what that specific discount rate would be at that point in time. Just have an accounting policy and, keep it simple. The next is lease terms. You can go down a rabbit hole of trying to, analyze the lease term on anything that has a renewal, especially equipment, or, you can analyze history and know, what you know about your business and establish a policy on lease terms for, say you have a bunch of vehicles and they generally are, 40 to 55 months, something like that. And that you generally, keep those through the end of the lease term. You could just say generally that every vehicle that we get, we're going to utilize 47.5 months, just on average. That's what we're going to do. So you have that option to take a portfolio approach, establishing accounting policies for lease terms as well as discount rates. I would do this on an asset class basis. You're going to want to, at transition, I would coach you to disregard leases that expire within 12 months of adoption transition. So if you're a private company and you're transitioning January 1st, 2022, and you have a lease that expires on 6/30 or terminates on 6/30/2022, you can disregard that. You don't really need to do anything with that because, in my mind, that's a short-term lease. It's sure at one point it was a very long lease, but that amount, that 6 months of that lease is probably trivial in the grand scheme of things. So I'm coaching my clients to disregard those leases that expire within 1 year. And you think it's material, yeah, sure. Maybe you do an analysis to determine what the impact would be. But I definitely would not put those into a software solution because every lease that you put into a software solution, they're going to charge you for that. Every month they're going to be hitting you for $6 to $10 per month per lease. So if you can keep those out of that solution, I would. And that's also for, vehicles, copiers, mailing machines, things that you have a large volume of, that you can get the data in a spreadsheet from the vendor or from the lessor. Do the analysis in a spreadsheet, especially if you're going to take the display approach to accounting, and you can just maintain that on a quarterly basis. Just get that data updated from the lessor periodically. Do not attempt to utilize, I would not recommend you to utilize the practical expedient to reassess lease terms. Unless you have some business reason for wanting to do that, I would encourage you not to. You have the way the transition guidance is written is you don't have to reassess lease terms at transition. And so I would not do that. I would just grandfather in the lease term that you established under 840, grandfather that into 842. And then once you get under 842 and you renew that lease, then you just create, and then it's a lease modification and you create a new asset or a new lease for 842 purposes. The last thing is just consider capitalization thresholds. I think about capitalization thresholds as a, percentage of total assets, and your total assets, depending on the amount of right of use assets that you're going to be reporting day one, are going to go up a bunch. It could go up, enormously if you have a ton of real estate leases. So reconsider that capitalization threshold as a percentage of your total assets, and perhaps this is an opportunity to refine that. Go from $1,000 to $5,000. Just that's something to think about. And then also materiality thresholds. Sure, you got a bunch of hand sanitizing machines around your headquarters, but in the aggregate, are they really worth the effort to determine the lease accounting impact? I would think not. So have some kind of management materiality threshold for what's meaningful to our business. What do our readers really care about? Do they care about Coke machines, or name your trivial lease, because we have leases all around us, and so just reconsider those thresholds.
Thanks, Buck. That's all the time we have for today. So thank you, Buck. Thank you, Courtney. And thank you all for joining. We hope you enjoyed this session. You have a great day.